Recently, I advised a buyer on the purchase of a franchise of a youth party and entertainment service in New York City, including all assets, inventory, intellectual property, and goodwill associated with the business. The advice included the preparation of the asset purchase agreement, due diligence of seller's inventory, vetting the infringement risks associated with seller's trademarks and their likelihood of registrability before the USPTO, and review of the lease of the physical location of the business. In the initial consultation, the client expressed his desire to execute a stock purchase because one, he wanted to step into the existing business with fewer interruptions, and two, he did not want to take the time to apply for new licenses and permits because he wanted to close quickly. Although his rationale was sound, it was incomplete. There are other important aspects of asset and stock sales that buyers should consider in order to determine which transactional structure will result in the highest possible value for their acquisition. The conventional wisdom is that buyers favor asset sales because said structures offer more favorable tax benefits for buyers. Indeed, tax basis may be lower for buyers in an asset purchase. Buyers typically pay more than the value recorded on the seller's books or the carry value for the assets purchased. The IRS allows buyers to use the higher step-up basis when buyers depreciate the expense on their taxes, providing a bigger tax break. For example, the inventory of the youth party and entertainment service are the chairs and other furnishings, themed props and themed decor, computers, and other trade fixtures. The seller's carry value for the inventory was $275,000. However, the purchase price allocated for the inventory was $500,000. As my client chose an asset sale, he is permitted to depreciate the inventory at $500,000. And the IRS allows my client to start over depreciation with the new step-up value. Conversely, if my client had chosen a stock purchase, he would be required to depreciate the inventory at $275,000, and my client would not be permitted to depreciate again any assets that seller previously depreciated. In addition to tax benefits, asset sales may offer buyers other advantages that stock sales do not. For example, buyers can attempt to negotiate that only those assets that are profitable for the buyer's business is included or included. Certain or all liabilities are not assumed, and select or no employees are retained. What are some of the disadvantages of an asset sale for a buyer? Buyers may pay more for the business in an asset purchase because sellers are likely to pass on to buyers the taxes on the sales proceeds. Asset sales can customarily take longer to close because of the due diligence that is required. For example, titles may need to be transferred or service contracts assigned to buyer, which transfers and assignments often require the consent of third parties. Vendors may desire to renegotiate contracts, and UCC-1 filing statements must be obtained to prove that assets are free and clear of liens. Buyers in an asset sale may be required to establish aspects of the new business, such as the registration of business licenses and permits that cannot be reassigned. In conclusion, the conventional wisdom that buyers should purchase all the assets rather than execute a stock purchase is often the most prudent course of action. In addition to the inability to step up the tax basis of the assets acquired, buyers in a stock sale customarily acquire all of sellers' liabilities. Regardless of whether buyers choose an asset or stock purchase, buyers need the advice of a seasoned business attorney to advise them on the structure that is most advantageous, to carry out thorough due diligence of the liabilities of the target business and the assets to be purchased, to draft and negotiate the transaction documents, and to negotiate a lower purchase price if the results of the due diligence indicate that the target is overvalued.